share with you the notes. So we're going to proceed with the notes that we have here. Okay, so last time we stopped at which notes? Which part? Which slide that we stopped last time? Up to which one? Any of you? Any of you? Slide 62, Najwa. I know that slide 62. Just want to know whether you are still there or not. Okay, so Najwa said slide 62. Yes, 62. 62. Okay. So means that you are there. Yeah. Okay, so the things become more complicated now. We have done a parts of the intra-group transactions. Okay, we have done for the inventory, and then we have the example 4A. Hopefully that you understand the example 4A. And then we look at the depreciable assets and non-depreciable asset. Non-depreciable asset is as simple as compared to the depreciable asset, because depreciable asset will involve the accumulated depreciation and depreciation expense. Okay, when you have depreciable assets here, okay, since the asset was sold at the selling price, so they're going to be the difference between the old depreciations and the new depreciation, because the asset was sold at the selling price. So we're going to record the asset based on the selling price. Okay, just want to go for this one. Okay, just repeat what we have learned last class. Okay, about the depreciable assets. For a depreciable asset, so once the asset was sold at the selling price, let's say going to sold from parents to subsidiary. So when they sold that one at a selling price here, so they're going to recognize a profit. And then they're going to sold this one, parents going to record at the book value, but the subsidiary going to record at a fair value. So the difference here will be a difference in a depreciation, which is the old one, and then this one will be the new depreciation. So, okay, they're going to recognize the first one is unrealized profit. The second effect, like the one that you have for the inventory, is similar. The treatment will be similar. But when it comes to the other things that you need to consider here is about the depreciation. The old depreciations will be lower. Okay, all depreciations will be lower compared to the new one. New depreciations will be higher. So once there is a new difference in the depreciation, we need to account for that one. So to look at to the depreciation based on the new depreciation will be higher, because the, let's say the one that bought is a subsidiary, they bought it at a selling price, so the new depreciation will be higher than the old depreciation. So we need to account for or make a correction for the depreciation which is over provided. For depreciations over provided, we're going to debit accumulated depreciation, credit depreciation, expense to show that this amount of depreciation has been over provided. So when we look at the tax effect here, so once you credit your depreciations here, your income will be increased. Income will be increased. So that's why we need to debit a tax expense and then credit a deferred tax. So this one is to record for the reversals on the eliminations of the URP. Okay, the eliminations of the URP, if that one is the inventory. So inventory, when you have the URP here, so when it comes to the next year, okay, the next year, the URP is here going to be realized. Okay, realized. But for the asset, depreciable asset, the realizations of the URP here is through the depreciations. We're going to do going to record for or realize for the profit here by the use of the assets. So going to recognize for the profit through the use of the asset to the depreciations accounts. Depreciations amount, the realization of depreciations. Okay, so we're going to continue with your notes here. Okay, so we're done with the, before we continue with the next one, with the intra-group transactions, is that you have intra-group transaction, the next issue is related with the dividend. Do you have any question before I proceed? We have done only two. We have done for the inventory and also for the asset. For the asset, we have both the depreciable and non-depreciable. So we have done this one. So we're going to look at the next one that we have here under intra-group transactions. Here is an intra-group dividends. I think that I need to close this chat box for a while. If you have any question, please try to voice out the questions because I need to close that one. Yeah? Okay, so we're going to look at the intra-groups dividends. So for intra-group dividend, the one that you have here is that dividend paid or payable by a subsidiary or received by parents. Yeah? Okay, when the subsidiary paid dividend, where's my pens? Okay, when the subsidiary pays dividends, okay, they paid dividends. Dividends here is going to be received by parents. Parents going to receive a dividends. Parents going to receive it. Okay, paid or payable. Paid means that you already paid, paid, and then going to have the parent going to receive. If the dividend is payable means that you only announced but not yet paid, and then for the parents it become a receivable. Okay, so in the group viewpoint, there is no change in the group profit. There is no change in the group profit, just shifting of profit from one location to another location means that you transfer from subsidiary to parents. Yeah, you just shift the profit, move the profit from one location to another location. So does not affect the changes in the group profit. Yeah. On the consolidation basis, the dividends income or received or receivable by the parent should be eliminated. Again, dividend paid or declared by the subsidiary. So you're going to debit dividend income and then credit dividend paid. Okay, so this is what for the purpose of the elimination. In Malaysia, the tax rule use a single tier system which the paying company paid the dividend and net after tax. So means that dividends is paid is already net after tax. And then the receiving company recorded dividend income also net after tax. So means that there is no tax effect for a dividend. If you look at here in your income statement or in a profit or loss, and then you have a profit and then minus tax, and then you have net profit. Okay, from that net profit, we used to pay for our dividends, or some of that amount we use as a, or we keep in the company itself as a returns earning. Yeah? So means that this dividend is already net after that because it paid from the net profit. Yeah. So we don't use the imputation system. We are using a single tier system. The intra-group dividend must be eliminated in full and the proportions of the NCI need to be allocated. So since the subsidiary paid dividend, so it going to affect the NCI also. So subsidiary paid a dividend. So this dividend will affect parent and also the NCI. So, yes. So try to look at examples here. Example 7. A acquired 60% interest in XY on 1st of January 2010 for a cash considerations of 160. The net asset of XY at the date was presented by the shares capital of 100 and RE date. So altogether, NIA here will be 180. Yeah? Okay, during the year 2019, XY XY paid dividends. So subsidiary paid a dividend of 140 net of the tax. Okay. AB is going to record. So XY paid dividends to parents and also to the NCI because we have only parent only have 60%. So the amount that I paid here is 140,000. So 140 paid. Okay, net of tax, and the AB going to record this one as a dividend income. They're going to record is a dividend income. XY going to record as a dividend paid. Okay. In the statements of comprehensive income, XY also make a proposed dividend. So proposed dividend here is you plan to pay a dividend of 60,000 and then recorded in a statements of financial position. Okay, this one is 60,000. Another thing, okay, you have two things here. The first one is dividend paid, okay, which is 140, and then the other one is a proposed dividend. So the journal entry is a difference between these two. Proposed dividend 60. This one is already paid, and then this one is only declared. You say that you want to pay a dividend. Okay. And then for this one, AB going to record this one as a dividend receivable. Okay, for the proposed dividend, AB going to record as a dividend receivable. Okay, receivable, and then XY going to record this one as a dividends payable. So maybe the other way. Yeah? Okay, and then corporate income tax here is 30%. So 30% for the income tax. So you need to prepare for the eliminations of journal entry for intra-groups dividends. Okay, for the dividend paid. Okay, remember that we have two things here. One is a dividend paid. So the dividend paid. So XY paid dividend to AB, isn't it? It's the name of the company AB. Okay, paid a dividend. So the amount that I paid here is 140. So XY going to record as a dividend paid. And then AB going to record as a dividend income. Yeah? So this is the journal entry. So you're going to debit dividend income 84. And then NCI here. NCI here from the amount of 140, parent only have 60%. NCI have another 40%. So the portion for the NCI here will be 56, 40%. And then credit, put it the word dividend paid here. Okay, just add the dividend paid, dividend income, and then dividend paid. Okay, this is to eliminate the intra-group dividend in the P&L and to allocate the intra-group dividend paid to the NCI. So we're going to eliminate the intra-group dividend and also allocate dividend to the NCI. So this is a journal entry for a dividend paid. Debit dividend income and also NCI, and then credit the dividend paid. Okay, and then the other one is for a proposed dividends. For the proposed dividends, there is the journal entry is a little bit different. You need to have two journal entry for a proposed dividends. Okay, the first journal entry for proposed dividend, we need to have two journal entry. One is for the profit and loss journal entry, and then the second one is to the financial positions, because the profit or loss here, once you declare a dividends here, dividends is considered as a considered as a payable, sorry, considered as a payables. But for the P&L, you also need to recognize for the dividends. Okay, so for proposed dividend, we need to have two journal entry. One is the journal entry that relate with P&L account, and then the other journal entry is to record in the segments of financial position. Okay, the first one, the debit the P&L account, debit dividend income. This one is for the parent portion. So 60,000, 60,000 that you propose, the XY proposed. So for the parent portions here, going to have 60%, so 36. And then the NCI here is another 40%, so you have 24. And then the journal entry, the account that we use here is a dividend proposed. Okay, look at here. The difference here, before this for a dividend paid, okay, for the dividend paid, debit dividend income, and then debit the NCI, and also the credit dividend paid. But this time you are using dividend proposed, because it's not yet paid. Okay, so we need to create that one in their income segment also. Okay, and then the second journal entries here is to record for a P&L. Sorry, so for segments of financial positions. So for financial positions here, we need to recognize for a dividends payable. So you're going to debit a dividends payable because we want to eliminate this one. Dividends payable, so 60,000, and then credit dividend receivable. So this one will record by parents. And then for NCI here, we put it under others creditors. Okay, others creditors. This one is for the NCI. So remember the journal entries here. For the proposed dividend, we need to have two journal entry. One is to record for the item in the P&L, profit and loss, which is dividend income, NCI, and then credit. The difference here is only this one, credit dividend proposed. And then after that, for the next one, for the segments of financial position, we still need to record for the segments of financial positions because the dividend is not yet paid. So we need to recognize for a payables dividend, which is in payable receivables and payables. So debit dividends payables, and then credit dividend receivables, that one have here, and then others creditor. For the NCI here, we put it as others creditor because this NCI here is already transferred to financial position. We're not going to put it again under NCI financial position. If you put it under NCI financial positions credit side, means that they're going to offset these two things together. But we put it under others creditors. For the NCI, we change this one to under others creditors. So any questions that you have for a dividend paid and proposed dividend? So dividend paid, journal entry is a simple debit dividend income, NCI, and dividend paid. But for proposed dividend, we need to account for two journal entry. The one is related with P&L. The second one is for the statements of financial position. The NCI for the P&L here, the journal entry is similar except for the credit side here. We are using a proposed dividend proposal. And then after that, we need to recognize for a dividend payable and dividend receivable because dividend is only declared but not yet paid. Okay. So any questions that you have for this one? For the proposed dividends and dividend paid. Any questions for this one? Is it okay? No questions, sir? Okay, so I proceed. Proceed with the next one. Okay, so proceed. Again, the others intra-group transactions. So for others intra-group transactions here, you may have the loans. Okay, you may have the loan. There is an intra-group loan that gives rise to the interest income and interest expense. So for example, here, parent provide loan. Okay, parent provide loan to subsidiary. So once for parents provide loan to the subsidiary, in return, subsidiary need to pay for the interest expense. They need to pay for the interest expense. And then for parent, they're going to have the interest income. Okay, so this is what we have when we have the intra-groups loan. Okay, the other one here is a management fees. Okay, management fee is normally charged by parents company. So they're going to charge a management fees from parents to the subsidiaries. They're going to charge the subsidiary. The effect of such intra-group transaction in the group must be eliminated. Okay, and then we have another example, journal entry for the intra-group transactions here. Okay, the first one, if it relate with the loans here. Loan balance. Okay, let's say parents provide loans to subsidiaries. To subsidiary, let's say 10,000. Okay, from parents to subsidiaries. So when you want to eliminate here, debit loan from parents, credit loans to subsidiaries. Loan from and then credit loan to subsidiaries. Just loan debit from, credit to. Okay, from parents or from subsidiary to parents or to subsidiaries. Okay, another thing that relate here is the accounts receivables and accounts payables between parents, and when there is a source of inventory or something that you're going to have account payable and account receivable. So to eliminate the account payable and account receivable, debit payable, credit receivables. Okay, and then relate with the in others in transactions here is relate with the management fee, rental and interest. Interest including the interest for loan. So debit, management fees, rental or interest received, receive, and then credit paid. Okay, receive and paid. This one paper and receivable, loan from, loan to. Okay, so that is what we have for others intra-group transactions. So the thing that you need to know here is the journal entries. Okay, any question for the last parts that you have for the intra-group transactions? For the intra-group transactions, altogether you start with the first one, you have the inventory. Okay, inventories here, you are going to have the elements of the URP. Okay, URP. And then the second one, you're going to have the fixed asset. Okay, for fixed asset, you have two types here. The non-depreciable, for example, that you have a land, and then the depreciables here. This one is become more complicated because it's going to involve your depreciation or depreciation overstated. Okay, and then the third one, you have a dividends. Okay, for a dividends, you have two types. The first one is dividend paid. Dividend paid only involve your P&L, P&L account, debit dividend income. Okay, and then NCI, and then credit dividend paid. Okay, the second one, you have a proposed dividend. So proposed dividends here, you only declare a dividends. So for proposed dividend, you need to have two journal entry. One is for P&L, and then the other journal entry is for segments of financial position. Okay, for P&L, the same as this one. You're going to debit dividend income, your NCI, but this time you're going to have a dividend proposed. Okay, proposed. Okay, and then in the segments of financial position, the proposed dividend become a dividends payables. Okay, dividend payable, credit dividend receivable, and then the NCI here become others creditors. And then the last one for the fourth one, you have others. Others here we're going to have the loan. Okay, loan from credit loan to. Okay, debit loan from credit loan to, and then accounts payable, account receivables. And then the last one, management fee or anything receive, credit, pay. Okay, so this is the four things that relate with the intra-group transaction. The most complicated is these two. So please make sure that you understand the upstream and downstream here. Okay. So that is what we learned for the intra-group transaction, all that four types. But for the inventories here, please refer to example 4A. The example for 4A for upstream sales and downstream sales. Things that you need to be careful here with upstream sales. So upstream sales here means that the subsidiary sells to parents. So subsidiary going to recognize a profit. This profit will affect both parent and also the NCI. Yeah? Make sure that you know the formula to calculate how much the allocations that we're going to allocate to NCI based on the when you have the URP carry forward and URP brought forward. Yeah. Okay, so there is four types of the intra-group transactions. So we proceed to the next one. Yeah, we proceed to the goodwills. Yeah? Okay. No, is there any questions relate with the intra-group transactions? Make sure that you remember the summaries here. The summary that I put it here. Okay. Okay, so I proceed. Proceed with the impairments of goodwills. Okay, so once at the beginning, when you calculate, when you bought a business, when you have the combinations of business here, you're going to calculate for the goodwill. So the goodwill is calculated as a difference between COI, cost investment by parent, plus the NCI, and then minus net identifiable asset. Okay, goodwill exists when your COI is more than NIA. COI and the NCI here. Total up these two, and then if there is more than NIA, then we're going to have a goodwill. This goodwill will be transferred to your financial position. But if the COI is lower than NIA, net identifiable assets here, we're going to have a bargain purchase. Okay, this bargain purchase is considered as an income going to be transferred to the P&L. So the thing that we're going to focus here, if in the case when you have a goodwill, when the COI plus NCI is higher than NII, and net identifiable asset. Okay, so your goodwill here is a part of your fixed asset, a part of your non-current asset or fixed asset. So your fixed asset here is subject to depreciation or amortization and also subject to impairment. But in the case of the goodwill, there is no amortizations and then there is more depreciation. So the goodwill here is also subject to the impairment test. Need to have an impairment test. So for the goodwill, we're going to conduct for the impairment test because there is no depreciation for the goodwill. We only conduct for the impairment test. So for the impairment test, we need to review every year. Okay, so the review of goodwill will take place at the level of cash generating units, mean that as a whole. So the partly owned subsidiary, if the NCI is measured at the fair value, partly owned here means that not 100%, means that we have a portion of parent and a portion of the NCI. So the problem here with this one, when the NCI is measured at fair value, the impairment loss here allocate to parent and the NCI on the same basis as that on which the profit or loss is attributed. Okay, based on the ownership interest. So if the NCI is measured based on the proportionate of net asset, impairment loss is allocated only to the parent interest. So you have to be careful for the goodwill. So it depends on how you measure the NCI. If the NCI is measured using a fair value, so means that there is a goodwill that we're going to allocate both to parent and NCI. So once there is a goodwill for parent and NCI, both party also going to share the same portion, if not the same portion, the percentage based on the percentage, the impairment loss. So because both of this one have a goodwill. But in the case when the NCI is measured at the proportionate of net asset, so the goodwill here, there is no goodwill for NCI. The goodwill is only for parents. So only parents going to account for the impairment loss. Okay, because when you using a proportionate means that there is no goodwill for NCI. So the goodwill here is only for parents. So means that only parents need to account for the impairment loss. So be careful what method that we use for the NCI. If NCI is using as fair value, there is a portion of goodwill for the NCI. So NCI also need to bear for the impairment loss. If that one is based on the professional, there is no goodwill for the NCI. So means that if there is impairment loss for the goodwill, only parents going to bear that loss. Okay. So we try to look at this one. This one we help you to understand about this one. Okay, what method that we use to measure NCI? If your method using the proportionate means that there is no goodwill for NCI. So when you prepare the journal entry, all the amount of the impairment loss, okay, impairment loss going to allocate to parents. So the journal entries here, there be RE, credit, goodwill, credit goodwill here is the amount of the impairment loss. And then this one, please gross up necessary. Later on, you want to understand what is a gross up necessary. So it means that if you use a proportionate method, we need to gross up the amount of the goodwill. Later on in the example, then you understand what is a gross up here. Okay, and then we're going to look at the second method, so that if you measure the NCI using the fair value, okay, so means that there is a goodwill for both parent and NCI. So once there is a goodwill for both parent and NCI, both of them need to bear for the impairment loss. So the journal entries here will be debit RE. So RE here is a portion for a parent. And then also debit NCI, which is a portion for the NCI, and then credit a goodwill. So no cross up. You need to cross up that amount. So this table is very important because you need to know what is the journal entry. You know from this table, you know the journal entry, what method I use. So please focus on this table. It's going to help you to understand about the impairments of a goodwill. Okay, so we proceed now. Okay, so we proceed with the next one. Okay, so maybe I try read a little bit. Okay, so now we try to look at the how we're going to record for the impairments of goodwill if the NCI is measured at fair value. Okay, so if the NCI is measured at the fair value, so the goodwill is stated in the full amount as it's present for both parent and NCI shares on it. So the goodwill is going to be allocated to parent and the NCI together with the impairment loss also going to allocate to both parent and NCI. Okay, the journal entry at the years of the impairment, debit impairment loss, credit goodwill. Impairment loss, and then allocate to the NCI, going to eliminate, okay, or deduct from the NCI shares in profit. For the NCI, going to deduct from the shares of profit. In the subsequent period, okay, debit RE brought forward, and then debit also NCI because NCI also bought shares for the impairment loss, and then credit the goodwill. So we're going to have two journal entry. This is in the current year, and then this one in a subsequent periods. Okay, we try to look at example for this one. Okay, at the year end, okay, the impairment review has been conducted on 80% owned subsidiaries. So parents have 80%, NCI have another 20%. Yeah? At the date of the impairments review of the carrying value of the net asset was for 400 and then goodwill 300, on which 40 is attributable to the NCI. The recoverable amount of the the recoverable amount here is 500. So, okay, to find for the impairment loss, okay, we need to compare between the CA and the recoverable amount, recoverable amount. And then we're going to have the impairment loss when the CA is more than the recoverable amount. Okay, the CA here, you just total up your net asset. So your net assets here is 400 and then plus the amount of goodwill 300. So altogether you have 700. And then your RA here, so your RA here, recoverable amount given as a 500. So out from this one is find that your CA is more than your RA. So CA is more than your RA. So you're going to have an impairment loss. So the impairment loss that we have here is 200. Okay, from this 200, we're going to allocate to parent and also to the NCI because NCI using a fair value method. Okay, we try look at the solutions given here. Okay, so the carrying amount you have 700. We already calculate. This one is NIA and then this one is a goodwill. So altogether we have 700. Recoverable 500. So impairment loss is 200. So debit impairment loss and then credit goodwill. This is in the current year of impairment. Current year. Debit impairment loss, credit goodwill. And then you also need to debit NCI, P&L, and the NCI to segments of financial position. So if you look at here, how they're going to calculate the NCIs here, the amount of the NCI here, you need to have 20% time with net profit. Okay, net profit minus 200. 200 here is from the amount of the goodwill. So means that the NCI is going to reduce going to receive the amount which is from the profit which is reduced the amount of the goodwill. They're going to receive less. They're going to receive less. NCI going to receive profit, current year profit. Okay, current year profit will be lower because of there is an impairment of goodwill, going to be minus. So this one that you have here. So you're going to prepare two journal entry. One is to record for the impairment loss, and then the second one is to record from the portions of the NCI. They're going to reduce the profit that going to be received by the NCI because the amount need to impairment loss here going to reduce the profit. Okay, going loss because it's have a loss, so you need to minus from the profit of the subsidiary. So once the profit of subsidiary has been minus with the impairment loss, so means that the profit will be lower. So the profit will be lower. So the portion that going to be received by the NCI also going to be lower. Okay. So is it any questions that you have for the goodwill under the fair value? If the NCI is measured at a fair value, the journal entry is this one, impairment loss and a goodwill, NCI, and then NCI financial positions. Any question for the first method? Goodwill at fair value. When the NCI is measured at fair value means that there is allocation of goodwill to the NCI also. So once there is an impairment loss, so the impairment loss also going to be shared by the NCI and parents. Okay. Now we move to the second method. So, okay, the method here is the NCI is measured at the proportionate of asset. So when there is a NCI is measured for proportionate of asset, there is no goodwill for NCI. No goodwill for NCI. For the purpose of conducting the impairment review, it is necessary to cross up. So we need to cross up the amount of goodwill. So remember the table that we have previously. So we need to have a cross up here. Okay. So you need to cross up so that the impairment review goodwill will include unrecognized goodwill that are attributable to the NCI, because you want to recognize the amount which is not yet recognized to the NCI. Any impairment loss is allocated to the recognized goodwill parent share based on the proportions of parent without affecting the NCI. The goodwill going to recognize. Okay, impairment loss is going to allocate to parent based on their share. But the first thing that we need to do here, we need to cross up. Cross up the amount of goodwill. Okay. In the year of the consolidations, okay, debit impairment loss on the goodwill and then credit goodwill, you're going to have the same journal entry. But for the subsequent period, you're going to have returns earning brought forward and then credit a goodwill. So if you look at here, there is no journal entry for the NCI because NCI do not share any goodwill. So there is no impairment loss for NCI on the goodwill, impairment loss for goodwill for the NCI. Okay, we try to look at this examples. And the year end, an impairment review has been conducted on 60% on subsidiaries. So parent have 60, NCI have another 40%. On the dates of the impairment review, the carrying value of the subsidiary net asset, okay, and net assets here is 250, and then the goodwill was 300, and then the recoverable amount here is 700. So remember that the amount of this goodwill need to cross out. Come. Okay, so this goodwill here, you cannot use 300, yeah, because this 300 is a net value to the parent. So we need to cross up here. How are we going to cross up here? So the amount of the goodwill divided by parent portion. Because that 300 is solely to parents. So this one you need to divide by 0.6, because this is the percentage that we have for parents. So this one will be 500. Okay, this one will be 250. So altogether, the carrying amount here will be 750. And then compare with the recoverable amount, 700. So you're going to have impairment loss. Total impairment loss here will be 50. Okay, so is it okay with this one? So the things that you have when the NCI is measured based on the proportionate, you need to cross up the amount of dividend. Why? Dividend, sorry, the amount of the goodwill, because the goodwill that we have here is only solely to the parents. So you need to know how much the gross amount of the goodwill. That 300 is solely to the parent. The total amount of the goodwill that you have here is 500. How we're going to find this one is a 300 divided by 0.6. So this is what you mean by cross up. We need to cross up. Okay, gross up. How the formula to find the gross up? The amount of the goodwill here divided by parent portion, because this 300 here is only for parents. Okay, so we find that the impairment loss here is 50. Yeah? So this is the calculations that we have. So the impairment loss of 50. From this 50, you need to allocate to parent based on their shares, parent shares. So parent shares here is only 60%. So out of 50 here, parent share for the impairment loss here is only 30. Yeah? So debit impairment loss and then credit goodwill 30. Yeah? Okay, so any questions that you have for goodwills? Please, do you understand this one? For the goodwills here, depends on method that we are using. If that one is NCI, based on the fair value, we don't have to do any adjustment, just calculate as a normal one. But if that one is based on proportionate, you need to cross up that amount. Please make sure that you remember the diagram statements. If that one is based on the proportionate, the journal entries here is debit the impairment loss, credit goodwill. If that one is based on the fair value, we're going to have what extra journal entries here is for the NCI here. Okay, any question for goodwill? Impairments of goodwill. So please understand this one, because most of the time we're going to have the questions related with the impairments of goodwill. Okay, I'm still waiting if there is any questions related with this one. Any of you have a questions here? No questions. Naura, so understand that one. What about the rest? We have so many here. Lee, is it okay with you, Lee? Lee. Okay, I don't say okay. What about the rest? You have Lee, Pua. Is it okay, Pua? Oh, okay. So we proceed, eh? Okay, proceed with the next one. Okay, the next one we have the adjustments. Adjustments of the fair value of the assets. Okay, adjustment in relation to fair value adjustment. So we're going to look at the adjustments here. So the problem here is when the subsidiary, okay, if the subsidiary do not adjust its book for the revaluations of depreciable asset at the dates of the acquisitions. If you still remember in the chapter 1 here, we look at the revaluation at the acquisition date. When there is increase in the value of fixed asset increase, then we're going to prepare debit, for example, your fixed asset, and then credit a revaluation surplus. This one is at the acquisition date. Now, in this situation here, there is no adjustment. Okay, we don't prepare this one. Don't prepare the adjusting entry or adjustment entry at the acquisition date. So at the acquisition date, we don't prepare this one. So once the subsidiary do not prepare the adjusting entry or to recognize for the revaluation surplus or adjustments of the revaluations of its asset, okay, we need to add additional consideration journal entry. Yeah? So for each subsequent period. So we need to prepare the journal entry, additional journal entry to record for a revaluation which is not yet recorded at the dates of the acquisitions. Okay, if the depreciable asset is deemed to be undervalued, so undervalue, let's say the book value at the acquisition date is 50,000. Now, based on the fair value here is 75,000. So it means that you're still using the old one without an adjustment. So the asset here is considered as a undervalue. So in the case when there is an increase in the value of the asset will be undervalued. So need to prepare the adjustment, need to provide additional depreciation because depreciation charge is understated. So when the asset is undervalued means that your depreciations will be understated. So we need to adjust for the depreciation stated. Okay, so once depreciation is understated, debit depreciation expense and then credit your accumulated depreciations. Okay, so this is in the case when the asset is undervalued. Okay, so let's say you are using the book value because you don't make any adjustment, but now the current value of your asset here is 75. So means that your depreciation is understated. So understated, we need to account for increase in a depreciation to record for the understated of depreciation. So debit depreciation, credit accumulated depreciation. If the depreciable asset is deemed to be overvalued, okay, overvalue, let's say the book value here is 50, but the fair value of the asset here is only 30. So it said that the asset is overvalued. So once the asset is overvalued, we need to decrease the depreciation charge. How to decrease the depreciation charge? Debit accumulated depreciation, credit the depreciation expense. So to summarize this one, if the asset is undervalued, okay, you're going to debit depreciation expense. Means that your depreciation is understated. Depreciation expense, credit accumulated depreciation. If the asset is overvalued, so overvalue, debit accumulated depreciation, credit depreciation expense. Most of the time you're going to have this one, yeah? Because most of the time your fair value is higher than your book value. Yeah? So this is in the case then when you don't make an adjustment to recognize for the changes in the fair value of your asset at the acquisition date. See? So we try to look at these examples. Okay. A acquired 80% interest in Z. Yeah? So A acquired in Z 80% on 1st of January 2016. Okay, during that this date, Z has a machinery of a book value of 50. Okay, at the dates of the acquisitions, and the fair value here is 75. Okay, this is the fair value. Suppose that when you do the acquisition, you're going to record the asset at fair value. Suppose that we're going to record is at 75. But it said that Z has not adjusted its book value. Okay, it does not adjust the book value means that it's still using a 50,000. Okay, so means that the book value is 50. The fair value supposed to be 75. So the asset will be under value. So under value because you still use the old one because you don't make any adjustment. So using the old one. Okay, the group policy was to depreciate machinery using a straight line method. The remaining useful life of the machinery was 5 years. Okay, based on the book value, the depreciation will be 50 divided by 5 is 10. But based on the fair value, the depreciation here will be 75 divided by 5, so it will be 15. So since you are still recording based on the book value, means that your depreciation here will be understated. Okay, understated by 5. Yeah? The difference between the old and the new one. Yeah? So you need to prepare a consolidation adjustments. Okay, so the first one you're going to recognize for the increase in the value of machinery. Yeah? Increase in the value, change from book value to fair value. Yeah? So recognize this one, debit machinery, credit revaluation reserve or revaluation surplus. 25 here is a difference between 75 minus 50. Yeah? Okay. And then you need to recognize since this one in the year 2016. Yeah? So 2016 now is year 2018. So it's going to affect your return earning brought forward. Yeah, return earning brought forward because this one is already happened in the year 2016. So returns earning brought forward here is 10, and then depreciation is 5, and then accumulated depreciation is 15. Okay, I'm going to explain to you. Okay, this one accumulated depreciation here based on the new fair value. Okay, the new fair value which is based on 75. Suppose that you need to record based on 75. The return profit here based on the old book value still using at 50. Yeah, okay. And then the depreciation that you need to recognize here is the understated amount of depreciations of 5. Yeah. So suppose that your amount of depreciations here will be 15. Yeah. Okay, so debit RE and then credit and debit also depreciation expense. So this one, the debit depreciation expense here is to record for the understated. Okay, and then RE here is because you reduce your profit by 10 here. Suppose that you need to reduce your profit by 15, not by 10, by 15. Okay. And then for the NCI shares here, NCI shares 20%. NCI put it PNL, PNL. This one is NCI financial positions here. So for the current year profit, okay, current year profit here, NCI here, the profit going to be announced by Z minus 5. Minus 5 here because of the understated depreciation. So you need to minus it because depreciation is an expense. So the amount of understated depreciation here, we're going to reduce the profit in subsidiaries. So debit NCI, the total profit need to minus 5 and then credit NCI to statements of financial position. Okay, for the shares of net asset, shares capital, okay, returns earning brought forward here is a returns earning brought forward minus 10. Why? Where this one come from? From here. Minus 10. Minus 10 brought forward. How much your RE brought forward? Minus 10 from here. Okay, from here. Okay, and then you need to time with 20% revaluation reserve and the NCI. Okay, so that is the adjustments of the value, changes in the value. If the company or if the subsidiary do not record for the adjustment at the acquisition date. So every year Every time you need to prepare the same journal entry, like this one, you need to recognize for the fair value, changes in the fair value. Then after that, effect to the RE and also effect to the NCI, the same journal entry that you're going to have here. Okay, any questions that you have for this adjustment? Any questions up to this one? We have done for the impairments of goodwill and then the adjustment. Other than after that, any questions that you have up to this that two things? Is it okay? Are you still there? Okay, so far okay. Najwa okay. Okay, so we proceed with the next one. So the next one you have good intrinsic. So good intrinsic here is a seller sends good. Okay, 200 at 10% selling price during the financial year. However, the receivable do not receive during the financial year. Okay, and then means that only receive the good after the financial year. Let's say there is a sale from parent to subsidiary. Okay, let's say the sale was sent on 30 of December. They're going to close the account on 31st December. Okay, and then the subsidiary only going to receive it. Okay, receive on 2nd of January, let's say 2021. This one is 2020. So means that for the parents one, they sense that they're going to uh, reduce from the inventory, and then they assume that the subsidiary going to receive that inventory. Yeah? The intragroup sales only recorded after taking into account all the assumptions that good have been received by the receivable. So we assume that we're going to recognize that intragroup sale once we assume that the receivable or the buyer received that goods. Yeah? So we're going to prepare the journal entry. The sale that we have here is 200. Okay, from that 200 here, there is 10% elements of URP here. Why you have the URP here? Because the seller sent good on 31st December. And then the buyer going to receive on the next year. So until the end of this year, the buyer still cannot sell the goods to the outside. Yeah, so they're going to receive, they're going to recognize for the unrealized profit. Yeah? Okay, so the first one is the journal entries that we have here. We need have to first journal entry. We need to have this one because we assume that the receivable already received the inventory. So you're going to debit the inventory and then credit the account payable. Assume that the buyer received the goods. Okay, buyer received the goods. So once the buyer received the good, they're going to recognize it as a inventory and then credit accounts payable because it's not yet paid. Yeah. Okay. The rest, the journal entry is the same for the one that you have for the inventory. Yeah. So you're going to debit the sales and then credit COS. Okay, the sales that we have here is 200. From that 200 here, there is elements of URP of 10%. So debit COS and then credit inventory 20,000 because of that 10% here. And then this one is the eliminations here. You're going to debit your accounts payables and then credit account receivable. This one is to close this accounts. Debit account payables and then credit the account receivables. Okay, so this is a good in transit. So we assume that the going to recognize that transactions when the buyer received that good. So we're going to provide, this is a new journal entry, which is to record for the inventory that going to receive by the buyer. And then for the eliminations here, we debit inventory, credit account payable. So for eliminations here, we're going to debit account payable, credit account receivables. Okay, any question for this one? Any of you have a question for this one? This is a good in transit. Good in transit means that until the financial year end, the buyer do not receive that goods yet. Okay. So they're going to increase the elements of the URP. Okay. So any questions that you have for good in transit?
Doctor, I have questions.
Which one?
So the first journal entry is under buyer perspective and the remaining is seller.
Sorry, again. Journal entry what?
The first journal entry debit inventory credit account payable.
Uh,
This one
mm-hmm.
is buyer record and the remaining three is seller record.
Mm-mm. This one is a buyer's record because the buyer is going to receive the inventory and then they're going to create the account payable because they're not yet paid. Okay, they're not paid, so they're going to debit inventory and credit accounts payable. So this one is the elimination. For the purpose of consolidation, this one is elimination because this one is a transaction between parent and subsidiary. So we need to eliminate these accounts payables. Debit account payable, credit account receivables. Okay. Is it okay?
Because I don't understand why I need to under the buyer record for the buyer and then record for the seller also.
Okay. Okay, at the beginning when seller sells good, okay, seller sells good, okay, they're going to debit. Since this is not yet paid, they're going to debit account receivables and then credit sales, isn't it?
Yes, yes.
So now and then for a buyer, buyer is going to debit inventory and then credit account payable. Okay. Purchase or inventory, but this one is inventory, yeah. You're going to debit inventory and then account payable. So for the purpose of eliminations here, sales here is already eliminated here. Okay, sale is already eliminated, and then account payables here and account receivables here is going to be eliminated from here. Okay, is you okay with that one? Who's the one asked me previously?
Oh yeah, me, Chong Hun Hui.
Is it okay with this one?
I yeah, I think I get it.
Okay, so again,
Doctor.
for this one again, okay, once again. Okay, we go for this one. Okay, so when this sales, okay, sales here, they're going to debit. Where is my, sorry. You have a sales, okay, you're going to debit your account receivables and then credit sales. Okay, this one is for seller. Okay, for buyer, they're going to debit inventory or purchase. Okay, but this time we are using the perpetual, so you debit inventory, yeah, and then credit your what is this one? Account payable. Okay, and then this one is the journal entries here. Since you the credit sales, now we're going to eliminate. We're going to debit here. Okay, and then the next one that we need to eliminate, since we have account receivables and account payables here, so to eliminate here is this one. So okay with that one? Inventory is remain here. It will be in your balance sheet. Maybe your balance sheet, and then we need to minus. Let's say your inventory here is 200, and then you need to minus 20 for the URP. Okay, so the amount of your inventory here is only 180. This one is remain in a segments of financial positions. Is it okay? Is it okay with this one? Okay,
Oh,
hold
I think
on.
okay.
Okay.
After you let me digest a bit. After that I read back.
Sorry again. I cannot hear.
Okay. I think okay. After that I will read back.
Okay. So understand about this one,
Yeah.
Okay. So this is about goods in transit. Okay, so we settle with the parent and subsidiaries. We have done with the parent and subsidiary for the intra-group transaction. So the other things that we have here, so many things that we have between parent and subsidiaries. The first one, you have the inventory, and then you have depreciable asset, fixed asset, you have depreciable and non-depreciables, and then you have a dividends, and then you have others, okay, others, and then after that we have issues here. Issues here is related with the goodwill impairment. Okay, goodwill impairment. So be careful with the NCI. Okay, is it at fair value or is it at the proportionate? Proportionate means that you need to, if that one is a fair value, impairment loss here will be both bear by parents and also for the NCI. But if that one is based on the proportionate here, the impairment loss here is only for parent because there is no goodwill for NCI. But to calculate the goodwill here, you need to gross up that amount. Okay, from the impairment loss, okay, to parents here, to parents, you need two portions only. Time with a parent percentage. Okay, and then the first one issue on the goodwill. The second one is issue on the no adjustment. No adjustment at the acquisition date. So once there is no adjustment at the acquisition date, your depreciable asset may be understated or undervalue or overvalue. Okay, most of the time is undervalue. So once you have the understated or undervalue, so undervalue you need to recognize for a depreciation, debit depreciation, credit accumulated depreciation. If the asset is overvalue, going to debit accumulated depreciation, credit your depreciation. Okay, and then the last one you have good in transit. So good in transit is this one, like the one that you have here. Okay, so many things that we have for intra-group between parent and subsidiaries. Four things, the main, which is inventory. Inventory, please refer back to example 4A. For A. And then for depreciables and non-depreciables, and then we have dividends. So for dividend, we have two type also, paid and proposed. Remember the journal entry for paid and proposed also. And then others. And the issue here is relate with the goodwill impairment. And then no adjustments at the acquisition date. And then the last one is good in transit. So this is the things that we relate with the intra-group transaction between parent and subsidiaries. Okay, so now we're going to look at the intra-group transaction, but this time between parent and associates. Associates here means that you're going to have a share which is less than 50%. Okay, so once the share is less than 50%, we're going to use the equity method. So the equity method, under equity method, if the associate announce for a profit, okay, when the associate announce for the profit, it's going to increase the investment. Yeah, going to increase the investment. If there is a noun for the loss, going to reduce the investment. And also another thing here is dividend paid by the associate going to receive the going to reduce the investment also. Right? Okay, so what is the equity method? So going to affect the investment. If there is a profit announced by the associate, going to increase the investment. If there is a loss, going to reduce the investment. And then also in the case when the associate paid the dividend, they're going to reduce the investment also. Okay, if parent accounted investment in associate using the cost method in a separate financial statement, consideration adjustment. We need to prepare a consideration adjustment. Okay, the first one is the shares in the profit. So we said that the shares on the profit here going to increase the investment. So if there is a shares of profit in the current year, debit investment in associate, credit shares of profit in associate. Okay, in a prior year, so in the prior year, we're still using the investment in the associate, but this time the shares of profit become return profit brought forward. This one in a prior year period, so prior year profit. In a current year profit, there'll be investment, credit shares of profit, but for the last year profit, still investment, but this time we credit the return profit brought forward. Yeah. So this is what we have for the associates. Okay. And then the other one is a dividend income. Okay, for the dividend income, this one we're going to reduce the investment. Going to reduce the investment. So debit dividend income, credit investment in associate. Okay, like the one that you have in part 2 of your note, chapter 1 of topic 1, part 2 of your note. So for the associate, if there is a profit, going to increase the investment, means that debit the investment. If there one is a loss or a dividend, they're going to reduce the investment. So means that the investment should be credited. Yeah? And then we're going to look at the intercompany transactions between parent and associates. Okay, others intercompany transactions, okay, there is still unrealized intergroup profit or loss are going to be eliminated partially to the extent of the interest in the associate. We still need to eliminate the URP intergroup profit here, but this time based on the percentage of shares that we have in that associates. The eliminations of URP are required in the inventory or asset that are still held by the buyer. In the case when the buyer still hold that assets or inventory, so we need to eliminate the URP, same as what we have in a subsidiary. The adjustment differ depending upon the directions of the transaction, whether that one is a downstream or upstream. So for the downstream here, we're going to adjust using the investment in associate. If the transaction relate with the downstream means that from parents to associate. Yeah, we're going to involve the accounts of investment in associate. But if that one is upstream sales from associates to parents here, the account that involved here is shares of profit in associate. So please be careful with this one. Two different account that we are using is downstream involve investment. If upstream here using the shares of profit. Okay. Be careful this one. And then remember this one, slide 84. Okay, we're going to prepare the channel entries here. Okay, so examples here we have a depreciable asset. When you source a depreciable asset. Okay, A own 30% interest in B. Okay, A and B, they have only 30%, yeah. So it cannot control, it's only an associate. Yeah? On 31st December, a warehouse constructed at a cost of 1 million was transferred between A and B. So there is a warehouse, the cost of that warehouse here is 1 million, and they have been transferred between A and B at the transfer price or the selling price here or the fair value here is 2 million. Okay, so the transfer here, there is elements of URP of 1 million. Yeah, okay, 1 million. Because the cost here is only 1 million, but the transfer price here or the selling price here is 2 million. So you're going to have URP of 1 million. Yeah? The group depreciate the PPE on the straight line at 20% per annum. So 20% per annum here means that the useful life here is 5 years. How do you know this one is 5 years? 20%, 20%, 20%, 20% up to year 5, then it becomes 100%. So the useful life of that machine here will be 5 years. Yeah? Okay, so the URP here is already calculated. Your RP here is 1 million. So 1 million is in a whole, in the total, yeah? But A only own 30%. So A only entitled 30% from this one, yeah? Because it's owned only 30%. The whole amount of profit here is 1 million, but they are entitled only 30%. Yeah? Okay, so we try to look at the downstream sales. Downstream sales account that involved here is a investment in associates. Okay, so account that involved here is investment in associate. Okay, the first one we're going to recognize for the gain. So the gain on the sales here, so because we're going to do the eliminations, the gain on the sales here, even though the gain here is 1 million, but A only entitled 30%. Okay, entitled 30% here. So the amount of gain here will be 300. And then credit investment in associates. So we are using the investment in associates account. Is that one is a downstream sales. Okay, from that gain is also subject to tax. Since the gain is not yet realized, so we're going to debit a deferred tax because this one is the URP. So URP here, you need to debit a deferred tax and then credit tax expense. We assume that the tax rate here is 25%. Assume the tax rate is 25%. So we're going to debit a deferred tax and then credit tax expense. Okay. And then in the years of 2018 and then 2022 means that subsequent year. Okay, subsequent year, we need to have this one. Okay, debit investment in associate and then credit shares of profit in associate and then also credit a deferred tax. Where this figure come from? Okay, 60 here. Where this one come from? So you're going to have the total gain that you have here is 300. That 300 here going to be realized when you use that asset. The useful life here is for 5 years. So every year you're going to realize 60,000. So we're going to realize 60,000. So that 60,000 here, you're going to debit the investment in associate. Once you realize here, debit the investment in associate, and then credit shares of profit in associate 45. From that 60 is subject to tax 25%. Okay, so you're going to have here investment, the one that you realize here, realizations of profit here 60. Okay, 60. And then the depreciations over provided by associates here is the 300 times 20 that you have here. So this is what you have. Okay, the one that you realize here, realize from the use of the assets. So the total gain that you have here is 300. So 300 divided by 5. 5 here is the useful life of the asset. So every year we're going to recognize, so the same year, the same journal entry that we're going to prepare for the next year, 2019, 2020, until the end of the useful life. Okay. So the amount that you're going to realize, the profit here is 60 through the use of the asset. So 60, where do you get this one? From this 300 divided by 5, the useful life, so you have 60. From that 60, portions for the profit here is only 45 because it's subject to tax, another 15 here. Okay, so this is what you have for a depreciable assets. Okay, so any question for this one? This is a downstream sales. So downstream sale account that involved here is investment in associates. Okay, I just finished with the downstream sales. Then upstream sale, then you look at the difference. Okay, now the upstream sale. So the upstream sales here is a sale from B to A, B to A. So B going to recognize the profit. So once B recognize the profit here, the account that we said that refer back to slide 84. If that one is upstream sale, the account that we're going to use here is shares of profit, profit in associate. Okay, so the total, because the asset was owned by B here, so they're going to credit the PPE. Because to credit the PPE here is 300 to record for the profit. So this is the profit here. The profit here, they credit the PPE and then they debit the profit. So the profit here is shares of profit. And then this profit here is also subject to tax. So from that 300, the shares in profit here is only 225 here, 225, and then the deferred tax here is 75 here, 75. Okay, and then for the subsequent year, you need to recognize for the depreciation expense. The depreciation expense was over provided here. So over provided, how much that is over provided here? The same thing that you have here is 300 divided by 5 here. Same thing. So you're going to have here a debit accumulated depreciations and then credit a depreciation expense. So once you credit your depreciation expense, you need to recognize for income tax, income tax or tax expense. Okay, tax expense 60 times 25 and then credit a deferred tax 15. Yeah? Okay, so the difference is this account that we are using. Yeah? Okay, for upstream sale, we're going to use shares of profit. For downstream sale, we're going to use investment in associates. Yeah? Okay, any questions that you have for this one? For the sales of asset. Okay, any of you have a questions? For the sales of asset? Okay, we have another 10 minutes. Can we just proceed? Okay. Maybe I take about 5 minutes, 5 minutes. Okay, and then for example of the next one is sales of inventory. Yes, sales of inventory. Okay, H own 40% of A, and the sale of inventory associate is 5 million. So at the end, they have 1 million. 1 million is the ending inventory. URP here, 1 million is not yet sales at the profit of 30% of the selling price, and then the income tax here is 30%. So your RP that you have here is 300 here because the 1 million with a profit of 30% there is remain in the ending inventories. Yeah? Okay, so you sales that we have here. So to recognize for the RP here, downstream sales, 1 million which is remain in the ending inventory. So you have 300 from that 300 here, you're going to debit sales. Sales here is only 40% out of like 1 million, so 400. Investment in associate, we are using investment in associate, 40% time with 0.300, so you're going to have 120. Cost of goods sold is 280. Yeah? This one is to eliminate the unrealized profit. Okay, so since you have the profits here, you're going to debit a deferred tax from this profit now. Okay, debit a deferred tax and then credit tax expense. Okay, so that is what we have. Okay, for downstream sale. Okay, for the subsequent year, the subsequent year, your profit here become 120. And then this 120 minus 30. 30 here is for the tax expenses. So the return profit become 90. Cost of goods sold 280. Tax expense 30 for the current year. And then credit sales. For this one is for the subsequent year to recognize for the realizations of profit. Okay, realizations of profit in a current year. Okay, so you realize the profit, debit RE, going to recognize for the profit. The total amount of profit that you have here is 120, but the 120 is subject to tax of 30,000. So you're going to recognize here is only 90. Yeah? Okay, and then this one is upstream sale. Okay, for us upstream sale, we are using the shares of profit, shares of profit in associate. Okay, deferred tax. And then credit inventory. Shares of profit here is 90 because this one is already total amount 120 minus 30 from a deferred tax. Okay, and then for the subsequent year, you got to debit your RE here and then credit shares of profit. Okay, to reinstate opening term profit and then to account for the realizations of profit. So once you realize the profit here, it's going to increase the shares of profit in associate. Yeah? So using the upstream, we are using shares of profit. Yeah? Okay, others example, others intercompany transaction between associate, you have loan to or loan from, amount due or amount due from, dividend receivable from the associate. This balance not going to be eliminated on the consideration. They should be separate disclosed in the consolidated financial statement under their respective classification. So this one not going to be eliminated. So the one that you eliminate here is only the intra-group transaction with relate with the inventory and the sales of depreciable assets. Okay, so I try to find exercise on the associate, the transaction with the associate. The one that you have in example in the gardens companies there, for a gardens Berhad here, okay, this one is relate with the intra-group, relate with the goodwill, and then you have the asset, depreciable asset. There is no transaction between associate. So just prepare that one for the next class. Okay, for the next class, we're going to discuss examples, gardens. At the end of your note, there is example for gardens. You have this one, example for gardens. You're going to discuss the next class, the answer for the next class. Make sure that you prepare the answer for this one. And then I try to find exercise for transactions where the exercise for the associates. If you have any exercise for the associate, just check your honor. But for this coming class, we're going to discuss on this example, but please prepare this one first. Going to show this, you're going to discuss this one together. We're going to do this one together. Together means that you prepare first, then we're going to discuss if there is any difference between your answer and my answers. We're going to discuss on that. Yeah. Okay, if you have any questions, so we are already running out of time here. We only have like another 7 minutes. If you have any questions, for those who have a class, please may leave the meetings. But if you have any question, I'll still be around for those who want to ask a question. But for the next class, please make sure that you prepare the answer for gardens and blue. Okay, gardens and blue here. Okay, do you have any questions? I'm still be here until 11:30. Yeah, if you have any questions. Okay, we are quite rushing here, so just go through again your notes here. If you have any question, maybe we'll allocate about 15 or 20 minutes before we discuss a gardens question for the next class. We may have a question during that time, yeah? Okay. So I just stop sharing this one for those who are not yet scanned for the attendance, or all of you already scanned for the attendance. Okay, for those who want to leave the meeting, you can leave the meeting. For those who still have a question, I'm still be around until 11:30. Yeah. Okay, if there is any questions. Okay, thank you. I'm still be around for those who have a questions. I'm going to share with you the attendance one again for those who are not yet scanned for the attendance. Okay, any questions that you have here? A bit rushing here. Please go through once again your notes. If you have any question, we're going to discuss that one again. Yeah. Okay, if you have any questions, still be around. Okay, comes here. Okay. Comes here. Going to add you manually. Okay.